Today was the longest we saw it go without a reversal. So this was a couple hours longer than it usually lasts. So we saw a couple of the negative headlines involving Cohen. We saw maybe the Brexit issue coming to a head. And like Wolf said, if this is a tremendous confidence vote on her behalf, the market should rally. If it's not, you're sort of splitting hairs, whether it's 90 votes or 110 votes against. That's what I think the market is hedging right now. If she wins, overwhelmingly, the market should rally into the end of the day.
Do you think U.S. stocks are teeing off of a confidence vote for the British Prime Minister?
I think they're trying to tee off of anything. Today it was China trade, it was Brexit, it's a whole host of issues. But the Huawei is eerily reminiscent of the ZTE. It seems like a leveraging tool on Trump's behalf. So I think that's why the market is rallying. Maybe they were worried about a headwind that really, truly isn't a headwind for the China trade talks.
And Rene, I guess the context matters for all of this stuff, right? I mean, you had the stock market's been under a significant amount of pressure. It has kind of bent near the lows of this correction, but not really broken. And there have been these attempts to show that, in fact, we can rally off those levels. So what does it mean for you in terms of either deciding what kind of returns are going to be available for this market in the short and long term, or just, deciding whether this move looks real for you?
Well, we are getting that every day. I tell you, Santa Claus doesn't look like it's coming to town this year. So the thing that really is concerning to me right now is getting this resolution on the trade tariff so it doesn't turn into a trade war. And frankly, if that does happen, it's not only going to impact and flip the script as far as the U.S. economy is concerned, but it's also going to be a big pull on the global economy. So from my perspective, I think if we can get this one major issue taken care of and getting some resolution on that, we do have a lot of other drama going on globally, but if we can get that resolved, that's going to make a big difference. The other key point I want to make is this. The tariffs, while it's been very short term so far, have already started to impact Q4 earnings. At the end of the third quarter of this year, companies were looking for, on average, about a 17% growth rate for Q4. They've already looked at downsizing those numbers by 20%. So for this fourth quarter, we're going to see some lower numbers and possibly even lower still, that there's going to be further adjustments. So if we can take care of this, because the tariffs are definitely having an impact, the rest of it, I think, will kind of fall into place.
So, Rick, two sources of anxiety for the overall markets lately have been the Fed and this trade war. Do you think we've seen enough improvement on either or both?
I think on the trade side, it's really an important issue, but it's important in a different way, in my opinion. It's not so much how much business we're impacting or how much the tariffs are costing companies. To me, the issue is you look at some of the post-tax changes. There's coffers of money that can be spent. There's money that hasn't really still come abroad with the repatriation. We still have money that needs to be put to work. And I think some of those capital expenditures are not moving forward in some part because of these global trade issues. And I really do think it isn't how much they hurt, it's how much they're impeding more growth, another spurt of growth. And I do think they will get resolved, but there's no doubt they're playing a bit of havoc with the markets. Having said that, I'm very optimistic that we have seen the low yield trade on the long end of the Treasury curve. We're about 10 basis points off those intraday lows from late last week and early this week on 10s and even on 30s. And I think that's something to pay attention to. There's many out there that think some of the better signals, even in a signal impacted economic environment, are coming from the U.S. sovereign debt market. And in that regard, I think we're getting some clues of improvement.
Yeah, Rick, there definitely has been some comfort taken in the relaxation of Treasury yields higher here. Do you think the curve right now is set up for kind of the December hike that most still expect and then a prolonged pause? How do you think the reaction function looks there?
It's hard to say specifically, but generically, I would agree with what you said. I don't see anything in the marketplace that would refute that the market's priced in and comfortable with the December rate hike. But I do see lots of substantial changes in the arrangements, especially in the Eurodollar futures, the short rate, not the foreign exchange, and in the Fed fund futures and options for 2019 and 2020. Will the Fed be taking along with some of those observations? I think they look at everything as closely as we do. So yes, I think a pause is in order. The only issue is exactly when they begin the pause, and will there be some activity in March of next year? I personally think it's going to be one and done for a while.